Let's jump right in. Today's explainer puts us in the shoes of a senior reviewer, and we're auditing a deeply flawed tax return for the Endeavor Engineering Consultancy, specifically their Pakistan branch. So if you love piecing together a complex puzzle while navigating some pretty strict statutory rules, you are in for an absolute treat. We're tackling question 4 from the ICAP CFAP 5 Summer 2026 tax exam.
This scenario, it's honestly a masterclass in tax traps. The tax manager for the EEC Pakistan branch has handed us a computation that is frankly riddled with fatal errors. I mean, it's a total mess. It's our job to forensically audit and correct the whole shebang before it gets anywhere near the authorities. So what do you think? Are you ready to spot the mistakes?
To keep things manageable, we'll group these corrections by theme. We've got 1. The flawed tax return. 2. Fixing business expenses. 3. Correcting depreciation claims. 4. Reclassifying other income. 5. Donations and remittances. And finally, 6. The final tax calculation.
Starting off with Section 1, the flawed tax return and a manager's missteps.
So, the tax manager calculated a taxable income of 204 million rupees, working down from a profit before tax of 560 million. But as we start combing through the working papers, we realize almost every single line item needs a statutory adjustment. Seriously, let's look at the first major error. The branch exported 150 million rupees in services to a client in Dubai. Now, because export services fall under the final tax regime, the FTR, the manager correctly excluded that 150 million from the normal tax pool. But here's the trap. You can't just deduct your FTR export revenue and pretend the associated costs don't exist. The manager completely ignored the 20 million rupees in expenses attributable to that exact export revenue. Because the income is FTR, those related expenses are strictly not allowable as normal business deductions. Boom! We absolutely have to add that 20 million right back to the profit.
Moving on to Section 2, fixing business expenses. Let's talk about head office allocations.
Okay, let's break down the math here, because it's super important we fix how the Pakistan branch handles the 205 million rupees in expenses allocated to it by the Singapore head office. First up, we've got a 100 million rupee management fee charged by the head office for centralized services. Under the tax law? Yeah, this is simply not an allowable expense for a branch, so we entirely disallow it. 0. Next, we deal with the remaining allocated expenses. The rules clearly dictate we must allocate head office expenses based on the turnover ratio. The branch's local turnover is 1,000 million, while the global turnover is 50,000 million. Doing the math, that means the Pakistan branch represents exactly 2% of global turnover. Finally, we apply that 2% ratio to the total global head office expenses of 5,000 million rupees. Well, 2% of 5,000 million caps the allowable expenses at exactly 100 million rupees. Since the manager tried to claim 105 million for those remaining expenses, we have to disallow that 5 million excess. Out of the original 205 million claim, only 100 million actually survives our audit.
Section 3, correcting depreciation claims. It's time for the withholding test.
You know, depreciation isn't just about the useful life of an asset. It's really about strict compliance. So the branch bought 600 million worth of equipment. 400 million came from commercial importers and 200 million from local manufacturers. But get this, they failed to deduct withholding tax on any of it. For the 200 million in local purchases, this failure is fatal. Tax depreciation on local purchases is entirely disallowed if the applicable withholding tax is neither deducted nor deposited. Therefore, 95 million rupees in depreciation tied to those local assets, it completely fails the test and must be added back to profit. However, the commercial imports safely pass. Why is that? Actually, it's because there is simply no withholding obligation on purchases from commercial importers. The depreciation attributable to the imported assets remains fully allowable. Honestly, it's a perfect example of why knowing the nuances of the law is just vital.
All right, Section 4, reclassifying other income. We need the right head for the right income.
Let's just rapid fire through these reclassifications, because the tax manager fundamentally miscategorized several major revenue streams. It's like a game of whack-a-mole here. First, the manager treated 50 million in interest as final tax regime. Nope, that's incorrect. Interest belongs in the normal tax regime, or NTR, under income from other sources. Next, they put 30 million of subletting income under income from property and took a statutory 20% repair allowance. But remember, and this is a big one, the Pakistan branch is merely a tenant, not the owner. Because of that, subletting income must be classified as income from other sources, which means that nice little repair allowance is inadmissible and has to be reversed. Lastly, the branch recovered 60 million of a bad debt. The total original debt was $80 million, but only $15 million had been previously allowed as a deduction. Because the $60 million recovered is actually $5 million less than the $65 million unallowed portion, the branch is legally entitled to a 5 million rupee shortfall deduction under income from business. Talk about a silver lining.
Let's look at Section 5, Donations and Remittances, Credits versus Allowances.
So our forensic audit definitely wouldn't be complete without examining a couple of massive cash outflows. Now, notice the crucial distinction here between an allowance and a credit. The manager deducted a 60 million rupee donation to the Sindh Institute of Urology and Transplantation, or SIUT, straight from the total income as a deductible allowance. But wait a minute. SIUT is a highly specific organization listed in the 13th schedule of the ordinance. What does this mean? It means it qualifies for a direct tax credit, not a deductible allowance. We have to add that 60 million back to the taxable income up front, and instead, we're going to calculate a tax credit later. And that credit will be limited to the lower of the actual donation, or 20% of our newly calculated taxable income.
Furthermore, the manager actually tried to deduct a 120 million rupee remittance sent back to the Singapore head office. Deducting this? Yeah, that is a fatal error. Remitting branch profits to a head office constitutes a dividend. It has absolutely zero impact on taxable income. I mean, literally none. It's simply not an allowable deduction, so this entire 120 million chunk must be added straight back to the taxable profit. No way around it.
And finally, Section 6, the final tax calculation. Let's bring it all together.
After stripping away all these wild errors, finding our true anchor metric leads us right here. We've added back the export expenses, we disallowed the head office excess and the local depreciation, we reclassified the interest and rental income, grabbed our bad debt deduction, and reversed the donation and remittance deductions. Phew! The true revised taxable income is exactly 450 million rupees. Guys, that is a massive, massive jump from the manager's original 204 million calculation. That's more than double, and this right here is exactly why forensic tax knowledge is so incredibly valuable.
All right, let's build out the final liability. First, we apply the normal corporate rate of 29% to our 450 million, which gives us $130.5 million in normal tax. Then comes the super tax. To calculate this, we take our 450 million and add 5.17 million of imputable income derived from those FTR exports we talked about earlier. That brings the base to just over 455 million. Applying the 7.5% super tax rate gives us 34.14 million. Finally, we apply that 13th scheduled tax credit for SIUT. The 60 million donation is well within the 20% limit of our new taxable income. So we just take the actual donation amount, multiply it by the 29% tax rate, and we get an admissible tax credit of 17.4 million rupees to offset the final liability.
I want to leave you with a final thought to really reflect on in your own practice. A flawless mathematical calculation. It's completely useless if it's built on a fundamental misunderstanding of the tax code. We just turned a 204 million rupee assumption into a 450 million rupee reality simply by applying the law correctly. So when you look at a computation, ask yourself, are you just checking the arithmetic or are you actually checking the law? Think about that the next time you review a tax return. Thanks so much for diving into this explainer with me today, and I'll catch you in the next one.